Okay, folks, welcome to Masterclass. I'm David Russell and VP of Market Intelligence here at TradeStation. Wanted to quickly just read this. All symbols and trading ideas discussed by the instructors are for demonstrational purpose only and are not recommendations. Strategy trading and active trading is not suitable for everyone. Futures trading, options trading, and active trading is not suitable for everyone. Past historical performance does not guarantee future results, may not be indicative of future performance. All educational content and custom easy language studies provided are examples for educational purpose only. Neither TradeStation Group or any of its affiliates suggest recommend trading scans, indicators, scans, strategies, or any other investment or trading advice of any kind. You alone assume any trading risk associated with the analysis and examples provided. Exchange traded funds are subject to management fees and other expenses before making investment decisions. Investors should carefully read this information found in the prospectus or summary prospectus if available, including investment objectives, risk strategy, risk charges and expenses. The prospectuses are available at tradestation.com/insights/ETF disclosures. Please see standardized returns tab in the included workspace. Performance data shown reflects past performance, is no guarantee of future performance. The information provided is not meant to predict or project the performance of a specific investment or investment strategy, and current performance may be lower or higher than the performance data shown. Accordingly, this information should not be relied upon when making an investment decision. All right. Well, good to be back with everyone. Let me know if you guys need the link. I don't have anything new, but most of you guys have had it from previous webinars. So wanted to quickly go over just what's interesting, kind of the market here. I mean, if I go to my main, I'm having some trouble today. I'm not sure why it's doing this. I restarted my computer and everything, and a lot of my indicators are just not working. And I'm not sure why. I'm going to, let's just try to. This is. Yeah, so basically, it's my computer. It just started doing this yesterday. I'm still gonna be able to show you some stuff. I'm just bringing the S&P. Can we have the link, please? Yes, I'll give it to you. All right, so first there is this zip includes most of the materials, the ELD file and all that, the workspace. This is another one that has a standardized performance. And this is another, there's another master class I did recently. It gets hard sometimes to keep track of all the zip files. So let me know if I'm missing something. It's tricky sometimes. All right, so I want to quickly, I'm going to start off by some things. Let's go to, if we go to tradestation.com/market insights, if you guys know or don't know my my blog, if we go here and we go to research insights. All right, so I want to point out this thing that I did on TradingView, and also the articles I did in the last. If we kind of look here, these articles here. All right, so the one with this guy here, the inflation guy, and the layoffs. To me, there's something that is emerging that seems evident that really has to be kind of appreciated, and that is the fact that both sides of the Fed's dual mandate are now far more positive for equities. This is an article I thought was pretty interesting, that layoffs have actually been on the uptrend as a theme, and it's only gained momentum since then. I think Amazon announced job cuts after I wrote this article last week. So the Fed has a dual mandate of inflation, managing inflation, and encouraging job growth. So as long as we were seeing a strong job market, the Fed could beat up everybody and fight inflation. But now that we start to see weakness in the job market, it actually reduces the Fed's hawkishness or their potential to be hawkish. On top of that, at the exact same time, the inflation news has gotten far better. I want just some of these. Let me just, one of my favorite things on the is Fred. This St. Louis Fed. Let's go to Fred used car. Just Google that, and this is going to show you. This is the St. Louis Fed's data tool, and if we go and we do, let's go to percent change. This will show sequential percentage change in used car prices. So that's month to month. Usually very insignificant. This was the very first. This in lumber. Look, here we are in like July. This is the summer of 2020. If you look at other things in this time, I don't have a chart of it, but the Institute for Supply Management's manufacturing index prices, they have this index they put out every month, the ISM manufacturing. That's the one that if it's above 50, it's expansion, under 50, contraction. That showed inflation way back in like August of 2020. And it turned negative last month. So now we have so what I'm saying is this is the leading sort of, the tip of the spear, whatever you want to call it, the leading edge of inflation. This spiked like a year to a year and a half before people started worrying about CPI. So these are now negative. And so I've written about this a bunch. And I mean, we saw it with the CPI. It is finally starting to trickle through, but I mentioned used car prices. It's also very interesting that some of the services like medical care had a really sharp drop. So at this point, when you look out into the future, the real pain has been housing prices and stuff, and that, might not fall quickly, but at the same time, is it going to go up very much? And that's, I think, one of the sort of problems here is, not problems, the circumstances now, we're in a situation where the market, and I'm not going to predict what the Fed's going to do in December, but we're at a point where the market can look out and see a better scenario. It's not very hard to imagine it anymore. The other thing that's pretty interesting, let me see if I can find this. Loretta no, it wasn't Mester, it was Lael Brainerd. Here we have her yesterday. Lael Brainerd, slow hike soon. Now maybe this policymaker was almost got Jerome Powell's job. It was her versus Powell, whenever the last time that came up. So, she's not chopped liver. So it's kind of interesting to see that. Mary Daly at San Francisco Fed said similar things too. Not, I don't know, 3 weeks ago, something like that. So we're at a point now where all these things are kind of pointing in a similar direction. So if we look at some of the stuff that I've written here on, I cover this in different ways on Market Insights, but let's, all right, I did this post last week. And what's interesting is I basically, let's just go over and look at the actual thing on TradingView. Remember, I post things on TradingView. It's an outside API partner that you can link your TradeStation account to. It's a way to, if for some reason you don't want to trade with the platform, or whatever, you can do the API link with it. You can, if you're curious and want to learn more, you can go to these articles and read. There's an actual page that will tell you about it and anything you need to know. But if you have a TradeStation account and you want to connect it, the potential exists. So a few things here. I basically looked at when the Fed started hiking, and I basically did, a little calculation, and it's roughly a full 12 months. 250 candles is a year when you take out weekends and holidays. So what's interesting is this is back in 1994. It was almost exactly a year between the Fed starting and the Fed ending, and then this kind of breakout. Now, remember, after this breakout in mid-94, the market had the great run of the late 90s. So I think it's interesting here. And a lot of people probably think that it's, overly optimistic to say something like this. But, I think that I see the potential to see something similar in the next 5 to 6 years. And one of the reasons is the fact that people are insanely negative right now. If you look, all right, the AAII, we go to AAII sentiment index. This thing is at like 25. Now, if you look at the history of this, in like 1994, it was at like 35 to 40%, and it remained highly negative all the way through the end of like 95. So the fact is that we're seeing a situation now that in some ways is even more bearish. The other thing that's interesting right now is that, we have a structural thing in place with the job market, of jobs being reshored and things like that. So there's a lot of underlying positives here that I just think that everyone has this degree of negativity that it doesn't make a lot of sense to me. When you actually look at history and you look at the internals, if you look at other moments in time, we had significant debt problems. Let's actually look at this. Look at Fred high yield spread. Now, if we were going into recession historically, like in here, yeah, this is up a little bit, but when you really look at this here, junk bonds are not showing any kind of problem. I'm going to show you something else, which is absolutely stunning. Let's go to Fred 30-year bond rate, the fixed rate mortgage. All right, now I'm going to do another one here. Let's go to Fred 10-year constant. This is a 10-year treasury yield. It's just a way to compare apples to apples. Let's look at this now. All right. So right now we're looking at 708. The current yield in the 10-year. Wait a second. That's the spread. I'm sorry. Spread 10-year. Sorry. All right. So right now, the 10-year is, 3.82. If you do the math, that's 326 basis points between the 10-year treasury and 30-year bond yields. Now, let's look back to 2007. We were basically just under, we were around 6.7. If you go back at that time, the yield was much higher. The yield at this point was around 4.8. So back then you had 190 basis points of difference. Now you have 320 basis points of difference. Now, wider spreads should correspond to a lower credit quality. But does anybody really believe that the housing market has greater risk of credit crisis now versus 2007? So the fact is that this is something that people will look back on, I think, and say that this was a too high of a yield. No, this. So what does this mean? There's a potential now for the next 1 to 2 to 3 years for banks to originate more loans, for rates to come down, even if treasury yields don't go down significantly. The other thing is that the banks now are taking like zero risk, and that's what you see with this differential. There is very little risk in mortgages right now. So all of this points toward an environment, in my opinion, more like the 90s coming out of savings and loan, a slow, steady improvement. Not a crisis, not a shock, not something like 2008 or 2020, but just a constant grind. And that's positive. So I think when you look at this overall right now, that these are laying the groundwork for so a real sustainable sort of improvement. And so I think this is an interesting thing to be looking at right now. One of the points I really wanted to make, because I think that people, when you look past this economic environment right now, or you look past this fear we've had with the Fed, there's really a lot to be positive about on the other side of it. Coming out of 2008, things looked absolutely horrible because, there really wasn't a lot of positive stuff of job growth. But something happened in the economy around 2015. If you look at the data, let's actually see if we can see it in this data. Let's go to Fred. It's probably just initial jobless claims, right? Fred initial claims, right? When you really look at the data, and this is not just a cyclical thing, you really start to see, like right around here, jobless claims. Just look, they were never really, the 90s, they were never below 300,000, and then they just go under 300,000. So from my assessment of this, and it's a complicated thing, but we are seeing an organic job growth in the United States. You guys might remember back in 2003, 2004, there was the expression a jobless recovery coming out of the dot-com. And the cause of that, in my opinion, was the spread of globalization. But now what we're seeing is, we're seeing these things come back. So all these things I wanted to put together, I've mentioned this before, but all of this continues to point in that same direction. All right, so let's look at some of the other things that are actually like in the market with my all right, so I just want to make sure I did cover these things on Market Insights that I wanted to point out. I want to emphasize there's this double pincer movement coming in on the bears. They're kind of like it, like the Germans at Stalingrad were like, the Russians were encircling them 50 miles to the west, and they just kept fighting. You look at it, on one hand, you have a weakening job market, and you have slowing inflation, and the bears just insist that the S&P is going to 3,200. I mean, they're just so confident of it. And that's, to me, something that I think is, we're seeing here is that, and we see that with the negativity. We see that with 25% of AAI bullish. There's still a lot of people who just have this religious conviction that the S&P 500 needs to go somewhere, down toward the old high of 2020. And when I look at the internals, like I said, well, I'm going to get to the internals, but when you look at these macro conditions, it doesn't point in that direction, in my view. The other thing here, all right, so now let's see if I can get I'm going to just use TradingView here because it's easier to see. It's easier to quickly jump around, look at the dollar index. But the dollar index now, I mean, this trend is broken. And when you look at, at this point, will it continue just straight lower? That's something where it's pretty extended to the downside. But the point with this is that this uptrend in the dollar at this point, it to me, I don't see a lot of reason to really think that you're going to see a sharp sort of improvement right now. The dollar does not look like it's going to have a violent kind of continuation to the upside. It looks to me like a broken trend, consolidation, and chopping. One of the other things I did over here on TradingView as well was this article on bond yields. Now, if you look at this, this is the 10-year, a weekly chart. There's a lot of patterns here that pointed to a top of this high from 2008, and this is a high from 2006 on the 2-year. So both of these at this point, let's actually look at, for example, the 10-year, is a similar sort of situation where there's, let's actually do a weekly, and you can see that we also have these resistance levels in play. So the fact is that, do I think it's going to go knifing lower? No. But by simply not going up, you have a situation where there's the potential for things simply to calm and for the fear to calm. So I think that's really where we stand right now. Another thing I think that's interesting is, and this is not a retail idea, but it's a thing to think about, is that back in the 90s, people were always refinancing their mortgages. Well, the thing is mortgage rates will probably not come down significantly the way they did. So you're in a situation where people who are buying mortgages and investing in mortgages have very little risk of refinancing. Because one of the things about mortgages is if you make a mortgage loan, they can pay it off at principal, and there's all sorts of things with the convexity of mortgages. But right now, there's much less risk of mortgages getting refinanced from under these banks, which is another positive to think about. So it's kind of like they're well capitalized, and at the same time, there's less sort of, refinancing risk. It's a really interesting situation when you look at, you're not going to hear about it on CNBC. For most people, it probably makes them want to shoot themselves with boredom. But these are structural things that we haven't had in place for a long time. And it sets up for some really interesting sort of opportunities across the overall market. And I think these things will be filtering through in the coming weeks and months. Now, let's look at some individual stocks. Let's go back to, wait a second, my workspace. All right, so this is the main masterclass workspace I work with. And what's interesting about this is, we start off, excuse me, the left tab with our key ETFs, and we look at some of these different areas. Excuse me, what's interesting for me, let's just look in the last week or so. The rebound in semiconductors is obviously very interesting, and I keep getting this problem with these errors. I'm not sure why. Anyway, that's not showing me these. If you were to look over the longer term, you'd actually see here that the growth stocks are starting to rebound against the against value, which is really not what that's not a surprise. But what I think is interesting here is that we've seen just a shift away from some of the safe havens. So we had actually been looking at some of these names. It was very interesting to look at a name like McKesson, which is also just, very unglamorous, but it was in a nice, just steady uptrend, strong earnings. Cardinal Health, same way. Some of these others like Eli Lilly, nothing is bad with them. General Mills, same way. Everything about it looks very healthy. But what's the problem? The problem is that these are risk off, and nobody wants these. This is a very interesting sign. As the CPI comes up, these safe havens have gotten slammed, and things like semiconductors have jumped. So this, in my view, suggests we're seeing a widening. Look at Goldman Sachs. Goldman Sachs has been just going straight up. Now, the thing is to me, this suggests that this is, now obviously at this point to make gold, this is not to say that Goldman is interesting here. Maybe we set an alert around 360, but what's interesting is, this kind of continuation tells me that this is a significant bottom now in a name like Goldman. So we have Goldman coming off a low and making this ridiculous move up. Now we look at semiconductors making a pretty significant move up, not as dramatic. All of these to me are potential signs of bottoming when you get this kind of strength. It's also interesting if we look at the S&P 500. The S&P 500, one of the things I look at is the 100-day simple moving average. We're now above that, and it's rising. We're above the 50-day. They're both rising. These are all signs to me of the longer-term trend, essentially, becoming more neutral. So I wanted to just kind of show that, because it's also interesting that, yes, we had a move like this back in August, and it was early, and the Fed basically kind of went back to their hawkish playbook. But if you look back here at this point in August, let's actually look, just think about this now, but look at the dollar index, in mid-August. It really hadn't done anything all that considerable, and it just had a tight consolidation. This time we see a far more significant sort of breakdown in it, under the 50-day, under the 200-day, and the trend line broken in the dollar index, which was not the case before. So from my perspective, this thing in August was an attempt. It didn't work, but it doesn't mean that the second time, will be a failure as well. Now, again, I don't want to be excessively bullish here exactly in the near term. And one of the reasons, actually, let me just go back to this, because I didn't actually show, where did this go? All right. If we go back to Market Insights. This article I want to mention, because I did some technical work on the S&P that right now, why, I encourage you guys to read the articles I do, because I put out a lot of this stuff when I can. There's this level here, and it's exactly where we hit today, within a few points. So you know, I wrote this saying how we were going to go back up and likely test that level. This was, so 39.10 is an important level. Look at the S&P. I mean, honestly, I've been surprised that no one else has talked about this level, because to me, it just jumps off the chart. 39.10, right where my cursor is here. It was this high in July, and then the low in late July, early July, late July. Resistance, support. Once we held it, off to the races. We come slamming down in September, and then where do we try to bounce? This sharp rebound there, come down, try to hold again, and then when we failed under 39.10, what was that high? 39.07. It was just pain. So that CPI number last week put us right back above 39.10 right here. It's also interesting, isn't it interesting, that was the high. The high was 39.12 at the beginning of November. So we've been talking about this level for months. And I wanted to just mention that once we broke above it, it really meant that there just wasn't a lot of opportunity for pullbacks. Once you break a level like that, when you're near it, you don't pull back right away. Typically, there's the money that will come off the sidelines and it will squeeze higher. And I think that was such an important level. So we write about this stuff, especially in the weekly story that comes out on Mondays. If you just look at the charting the market section, we'll break all of this down. So anyway, in this section, we basically said that traders may watch 4,100, and it's near this level from here. So if we look here, well, 4,100 is the overall level to watch. But what's important is we pointed toward this gap, which is exactly where we kind of went up to today. So to me, this is a next sort of thing that is interesting. As we look out, though, next week we have Fed minutes. So near term, from my perspective, this market is now in a little bit of a spot when it's just kind of tight, and, you know, probably the big index moves are over, and we're going to see the shift now towards just sort of individual stocks. The VIX has fallen a lot here, and, you know, the question is, will we make a higher low on the VIX? I mean, I usually don't look at the VIX per se for charting purposes. It's interesting to see when it actually kind of starts to move here. But what I think is interesting is that one of the kind of principles I use is that in the beginning of a move, you see the index working, and then later in the move, the index stops. It first rallies 2 to 3% a day, and then in the end it goes up. It barely moves, and individual stocks move as volatility falls, and that's where I think we are now. Now's the time to be looking for individual stocks, individual sort of things that can make moves. So one of the ones I wanted to point out that I'm actually right now, I'm actually about to publish an idea on TradingView on Nucor. The steel makers to me are pretty interesting. Like I said, the economic outlook is, in my opinion, the strongest it's been since probably the early 50s. If you look at that point in time, people had all these savings bonds. You had the economy retooling for domestic consumption. You had very low unemployment. You had bond rates that were coming down. It was a very positive outlook, and you had this huge runway ahead of home building and domestic sort of expansion coming. And that's really what we face right now. And if you look at this, the steel makers are very interesting. So Nucor is the only steel maker in the S&P 500, which is kind of incredible when you think about it. It's pretty interesting here. If you look, I'm working on a chart that I'm going to be putting up on TradingView later today, but the main point is you have these essentially a bullish triangle here. If you look at these higher lows, right, you know, low, and then this resistance here, we broke. So let's look at the actual close right around 138. That was our high close at the end of, that was our daily, closing high. Once we close above that, it's interesting how it just magically happened in the next month. It's fascinating how these candles work out. So you get these months, the weekly candles. But anyway, we broke above it, we held it, and now we're moving. This level is pretty interesting. I mean, to me, this is a very interesting chart. This is one that was coming up on my list. All right, another one on my list is Etsy. And this is one that I've been watching for a while. And honestly, this is like the trades that I find this trade the most difficult trade when things come off these lows like this and they just make these surges higher. To me, Etsy right now has, a lot of these like COVID growth stocks. A lot of these COVID growth stocks, like the Zoom videos and all these crazy Cathie Wood names, most of them will probably be long forgotten. But Etsy, it just seems to be doing something right. This company is in the S&P 500 now. It seems to have crossed a threshold into, legit status. This is one that I have missed, I have watched, but hopefully we can find some opportunities in it. This is one that I think is what we want to have on our list. So what we can do now is when we look to monitor things, an idea like this is, I have provided the this alert. If we do something like the MA tools, if we have a name like Etsy here, look for it to test its 8-day exponential moving average. That would be an alert. Now, I have provided an alert called, in fact, why don't you guys do me a favor? Go to your studies, just go here to like go to studies, add study, see if you have EMA with alert on cross. EMA, this one. You should have it from the zip files I've shared. If you don't, I'm going to give it to you right now. But what this does is this will can trigger an alert when it pulls back to touch a moving average. But let's look at some of these others. SE is another Cathie Wood name. Massive move. Garbage for so long. And again, a lot of these names are, in my opinion, not nothing that are like actually ideas in terms of trading now. But what's interesting to me is that these tell me that the conditions have changed in the market. We are no longer in this sort of, there's more evidence of the fear having passed here. When we look at something like this, we see with C, there was another one, this Chinese name, Huya, which is also one of these Chinese, I think it's an esports or video game name. Look at the big move today in Baba, all these Chinese names now. So these have me right now thinking about NEO, LI, and XPEV. I'm starting to look at them and wonder, the long-term growth story for Chinese electric vehicles and stuff is interesting. And a lot of these stocks, these three names have not gone up yet. I want to look at them and start to study and get an idea about them. But these are all names that, if you look at, they seem to have some interesting sort of things happening in China. Last night we got this horrible news out of China, but in some ways it's like once that bad news is out there, that's when people step in to buy. And it was like, I think it was industrial production and retail sales were both bad. The Chinese economy is a mess, but at the same time, if they take away some of their COVID restrictions and other things, again, you're looking at a situation where it can get more likely to get better than worse. At least that's where the market wants to position itself now and think. And if you think, say 50-50, it gets better, it gets worse. If it gets better, you look at a stock like this that was in the 30s and now it's under 10, from a risk reward perspective, that is how the market is thinking. And if we mine around and dig into some of these, we can still see a lot of things like this. All right. Another thing that I'm looking at that is interesting to me is, the fact that XLE here could be, I'm not saying this is a short or anything of the sort, but if the energy sector kind of just stalls out here, that is another thing that could be interesting, because there's a lot of people who've just been obsessed with energy all year and just convinced that like the tech and stuff is horrible. It'd be interesting to see if we start to see some money drain away from the XLE and the energy names into more of the growth. And that's something I think we want to keep an eye on. Another thing I want to point out, potential, if you're looking for just some, some shorting or anything like that, the financials are back to an interesting resistance level here. So I think this is kind of interesting, like I said, with things like Goldman here. To me, Goldman is it's a very interesting move. The question though is, after a move like this, you could probably set an alert around 360. And a name like this could have a decent retracement. So this is one for me where I'd be starting to think about setting some lower alerts on a name like this, and waiting and watching and looking for the things with the shorter term strength like Nucor to kind of see if that pops anything up. Another one was, the last time we talked, I was talking about HLIT, and we had talked about it as it was pulling back, and it came down to the 50-day moving average. So I'm working on I'm working on an indicator that will be kind of like an everything that will. It's like when you see a stock, because the problem with this is you see it pull back, and then it's like literally, there's a lot of ways to think about watching it. And one of the ways, for example, is the MA tools. This would have popped up on the 50-day MA test. It would have had, if you look at HLIT, it would have triggered an alert right here and right here on a Friday and the Monday. But I'm actually trying to create something that will watch multiple things. Like, it'll watch the 50-day moving average, a 21-day exponential moving average. It'll watch the Keltner channels. I'm trying to kind of put all those things into one sort of indicator. It's an idea to kind of view. What's interesting now is, if you look at the names that have pulled back to like the 50-day moving average, they're all the sort of safe havens that did well before the inflation report. So ELV is some kind of health insurance company, Progressive, all these safe names like the property and casualty names are all just kind of languishing here. So it's I'm starting to wonder if some of these names, some of the health insurers like UNH and stuff, I'm watching to see, do we start to get down to these levels where they had this support in mid-October. But at this point, the short-term momentum in these doesn't give us anything. And I'm looking for a sort of expansion into some of the smaller sort of higher beta names as the VIX comes down. And from my perspective here, when you look at what Brainerd said, and then when you look at the Fed minutes next week, it seems to me that we're in a spot now where we're going to see a widening conviction of a dovish Fed. And as that happens, we could see more of an upside into the next Fed meeting instead of downside. And I think if that's the situation, we want to be looking for some of these little crazy names coming off the lows to be potentially fighting higher or more. It's also interesting to look at when you look at the, Carnival, RCL, a lot of these names, again, a lot of signs of bottoming here across the overall market. So I think, as that happens, there's going to be more, it's just going to be a kind of spreading strength. And so from my perspective, we're still in a spot here where, the market has bounced nicely, but there's not a lot of real warning signs yet, in my view, to the downside. If anything, it's a widening sort of strength. So when I last week did my market breadth webinar, and what's interesting is when I did that webinar, I highlighted this was a signal that we really got from the equal weighted index. And when this is red, it's actually positive. What it means is that it means the equal weighted index was outperforming the large cap. So it's the market cap weighted S&P 500, and we saw a very significant sort of breadth improvement, which is pretty interesting to me. Now I will tell you, my next Art of Trade station is going to be on December 8th, and it's going to be about finding opportunities in any market. I'm going to be using a lot of the same principles that I used in this master class, and I'm just kind of looking at this to kind of get a sense of it. Because for me here, what's really interesting, I'm really just looking at Nucor, and I'm just wishing I could. I mean, to me, I'm just watching, see if we get a breakout in some of these names. Another thing that we're seeing that's been very interesting has been a rebound, especially the Democrats doing decently in the midterms, is a rebound in the solar energy. So the TAN has had a very significant move here. There were some upgrades of Enphase recently, of Sunrun. First Solar has been unstoppable. And what's also interesting to me is kind of looking out at some of the lithium producers. SQM reports earnings tomorrow. ALB, we had written about some of these guys recently. LTHM, from my view, when you really look at it right now, these names, the growth, the real sort of growth areas that we want to be focused on are the green energy names. All right, let me do this. Let me find this article. I wanted to share this with you guys. If we go to ENVX, let me find this one. All right, this article, I wrote it back on September 7th. If you search for lithium or ENVX, I outline a bunch of these key names in this article. Also in this recent trading view, I outline these lithium stocks. What's very interesting about these is a lot of these stocks have some very interesting sort of, the longer term charts are more bullish. Sometimes you catch these crazy names like AMD or Etsy coming straight off the lows. You sometimes catch those, but it's usually more straightforward to be focusing on the stocks that have the nice kind of clean up trends. So I wanted to mention these lithium stocks are just in a very interesting spot right now. There's about 5 of them in the overall market. Also, if we go to lithium price, it's on, where is it? It's on Trading Economics. Yeah. So look at this chart. Just Google lithium price trading economics. And what's interesting here is the price of lithium, even with, this year, with the Fed raising rates and stuff, it really has not pulled back very much. And it obviously, and it started to break out here in September. So I just think it's pretty interesting when you think about this. Tesla, whatever. I mean, you have all kinds of confusion, and but then you have the companies that provide the underlying commodity that is needed for these electric vehicles. So I wanted to just kind of highlight that. To me, this is one of those areas that seems to have a pretty decent structural demand story. All right, now, let me see some other questions. How did you get the trading view where the info is on the left side instead of the top line? I don't understand your question. If you want to be more clear, where it's on the left side. You mean the right side, like this? The data line. All right, well, so trading view, if you hang over. All right, so if you want, this is like a watch list. This thing that looks like a list icon. Oh, where you have all the EMAs. So you might have it so this thing pops up and down. This is actually a weird thing. This is my personal chart, but I'm currently logged in as TradeStation. So like, the reason is I'm about to publish this Nucor thing right after the webinar when I get it approved. I'm going to be publishing this thing I showed you about Nucor. So anyway, I think you're looking at this. The indicators have a little drop down caret thing. So that's what I'm showing you. If you hover over things, then it will show you up here the high, the low, and all that. It's pretty similar to TradeStation charts. Pretty cool. The real drawback of TradingView is they do not have radar screen. And that's it's such a huge asset when you have radar screen. All right. Now I had a question. If you go to, well, let me first run through these charts, and I'm going to end by building something because someone was asking for it. Let's just look at like ES charting. I have the 4 chart futures I gave you guys. What's interesting to me is the look at this level right here around 39.80. This level is what we basically held. This is what I like about having, this is a 4-hour chart and there's a 1-hour chart. So the way I use this indicator, excuse me, is we want 2 of the 3 to be bullish. And what's interesting here is that MACD started rising and the 50-hour was rising. Therefore, that was a bullish sign. It was a bullish indication before we had the PPI today. But like I said, in my view here, and you can see that this is the daily with the what do I have here? I have the 5 and 10-day moving averages on this. Very simple. But what's interesting is you can see that we were right up, kind of flirting with that gap. So to me, I think we're going to just see some tightness there. Not significant upside or downside. The index, I think, could just snooze, and the individual names will move, like I had said. This is the hourly. There's really, as you can see, nothing here super clear. Depending on what happens, 39.10 could be a retest level. 39.10 right there, this high, like I said, this level I'm obsessed with. This could be a level to retest. But we might need to get to the Fed minutes or something after it. Maybe we drift higher into the Fed minutes. But I think we want to really be cognizant of that 39.10 level. My overall, thinking would be that it will be retested, but the question is, what will be the thing to trigger it? We'll have to see. At this point, we're above the 8-day moving average, all the short-term moving averages. And the idea of an immediate sort of reversal here, to me, there's nothing that points toward that. The sector analysis, well, let's actually look at the solar. I don't know. I mean, I continue to think right now that this is an opportunity that is, it's kind of like, it's kind of like mortgages 30 years ago. The government used to do all kinds of things to subsidize housing. It led to a bubble. And now they're doing stuff to encourage this. It will probably lead to a bubble, but we're not there yet. So the thing is now you have a sector that is, there's a lot of support for it. Another problem with green energy historically was that there was a knack of oil to get cheap. After they started doing solar houses in the 70s, oil came down. And then after they did it in 2006, oil came down. But this time, I mean, oil to me, it doesn't look to me like it has a lot of upside in the near term, but we're not going to probably see oil go collapsing back down to like $50 a barrel or something. So, with oil in its position where it is, and the government supports in place on this, to me, it seems like the solar energy and the green energy is an area we want to be increasingly aware of. And it's interesting. So this shows the spread of the ETF against the overall index. And it's interesting to look at this, is that basically what we're seeing here is that we are seeing an interesting sort of inverse head and shoulders. We had this big run up, and we're not. Now let's look at the Cathie Wood ETF, right? Look at ARK against this, or I'm going to just put it up. I mean, this is a bleh. This is like, bottom falls out. So this is Zoom. This is, a lot of the other tech stocks. Look, even the Qs, for example. I mean, this is a much more, there's no sign of anything really all that positive about the Qs against the S&P. But then look at the solar energy, high or low. So interesting sort of basing here. And to me, this is a very interesting sort of thing to look at. So this sector analysis, it allows you to look at a whole series of different indexes and ETFs against the broader market. All right, let's see what else we have now. We actually have some weakness in the S&P. Let's actually see let's actually kind of see where the weakness kind of is. Things like gold miners. It's hard to quickly dig in and see. I don't have this set up for my intraday analysis. All right, so I had a request. I'm going to show you guys how to do this. In fact, I think I can do it easily from this. Go to breadth. I'm going to copy this. So someone was asking me, can you please do the Dow? Can you do a breadth for Dow? Because I have it for the S&P, I have it for the NASDAQ 100. And so this is the S&P. So first I'm going to change it to DIA. Now I'm pretty sure I've shared this with you guys. It's called the calculated. It's somewhere in the, it's the calculated indexes. All right, called TradeStation calculated indexes. If you don't have this, you can let me know and I will share this with you. It's a PDF, advancing and declining issues. We actually go here to. There's a series of indexes. This actually includes all of the, all right, so these are the breadth indexes, and we want to look for NYSE advancing. You know, this is actually gonna, here we go. $ ADVI. So we're gonna go here to data, and we're gonna go to edit symbol, and we're going to replace the S&P advancing with the Dow advancing. So it's, what was it? $AD ADVI. I'm gonna put that in, and that's changing this thing down here, and that's gonna immediately then we got to also do this DECI. I have that right? Yes. All right. Let's hit OK, and let's see what happens to our advanced decline line. Okay, it still works. Now, what I did with this is this is on the left axis, so I can shrink that down like this, which is what I did. So the advanced decline line works. Now we want to look at our WHSP. All right, so this is the S&P 500 new 52-week highs and lows. There's going to be a similar one for the Dow. Dow new 52-week high, it is this. Go over here and go to data, edit symbol, and we're going to change 52-week high. We're going to do S&P 52-week highs. We're going to change that symbol to this. We're going to change the other one to this. And now this is when I'm done is going to be also going to show. See, it doesn't work as well because the Dow doesn't have enough members to have anything very serious. The S&P is the low of the day. Interesting to know what's actually happening. I'm going to just finish doing this, and then we have this MAASP. I'm going to search this document, and this is the S&P 500 above and below, but now we have the Dow. So we're basically looking for, these are the companies above the 20-day and above the 50-day. We're going to do it for the Dow. So it's going to be number. We're going to go for the Dow issues above the 20-day moving average. This is the symbol. You can just change it right here. And then see, this is totally off. Now we're going to change it. Now we're going to do the Dow above the 50-day, which is the red line. So I think you guys see why I tell you don't mess with this breadth chart. I wanted to show you I can go through and do all those sort of things. And now this was a request I had gotten from somebody, and now this will show you a similar sort of thing. I wanted to show you how I had kind of built it. You know, it doesn't look very good for the Dow because there's not that many companies in it, and you get this weird jumpy data, which is the reason why when I originally did the breadth, I didn't include the Dow because I knew it would do something like this. So anyway, I wanted to just kind of share this with you guys to kind of see how some of these things can be built. And so hope everyone has a great day. I am going to be doing a sort of analysis of the market, or an explanation of ways to be looking for leadership and analyzing sentiment. A lot of the sort of stuff I do. It's going to be on December 8th. Hope you guys can make it. It's always good to talk to you. If you do have any questions, I don't have, where do all the EMAs? I don't have that. All right, wait. Email me and I'll share this PDF with you. It's a PDF. It's in one of, if you actually look through some of these zip files, it's somewhere in there. It's a PDF. It's called TradeStation Calculated Indexes. If you cannot find it, it's in there, I'm pretty sure. Email me and I will send you the PDF. So it's great to talk to everyone, and I will see you again soon. Take care.